Bonjour, chers collègues.
Good afternoon, colleagues.
25 of the Standing Committee on Public Accounts, Thursday, September 29th, 2016. I remind everyone that we are televised today, and so I would encourage you to, and I haven't done it myself yet, but to turn off your cell phones or at least put them on mute or vibrate, and it just lessens the disruption both here, and it also sometimes, if the mics are on, it really distorts everything else. Today we're conducting a hearing on Report 1, Venture Capital Action Plan, from the Spring 2016 reports of the Auditor General of Canada. Do you want that now, or do you want me to finish my...
Whenever it's appropriate, Chair, I would like that.
I'll recognize your point of order immediately after. Appearing before us today, we have, from the Office of the Auditor General of Canada, Mr. Michael Ferguson, the Auditor General of Canada, and Richard Domingue, Principal. From the Department of Finance, we welcome Richard Botham, Assistant Deputy Minister, Economic Development, Corporate Finance Branch. Good to see you again. From the Department of Industry, Christopher Padfield, Director General, Small Business Branch, Small Business Tourism and Marketplace Services. Jerome Nitsch, forgive me if that's a mispronunciation, but Executive Vice President, BDC Capital, Business Development Bank of Canada. Neil Hill, the Vice President, Market Development, BDC Capital, Business Development Bank of Canada. I understand that we have an opening statement by Assistant Deputy Minister Richard Botham. We'll begin with the Auditor General of Canada opening statement, but before we begin, I would like to advise everyone that we have with us today a 6-member delegation of international auditors currently undergoing training with the Canadian Comprehensive Auditing Foundation. These auditors are from Vietnam, Tanzania, Ghana, and Cameroon. We will have an opportunity to meet with this delegation and our international colleagues at the end of today's meeting. I can advise our guest auditors that the Canadian Comprehensive Auditing Foundation has also been very generous sharing advice and helping our committee train for our work early in the 42nd Parliament. As your chair, I wanted to alert MPs and witnesses who will want to be mindful during today's meetings, as we have these international auditors here, and we would really like it if they all thought we got along all the time. No, it is good to have them here, and we look forward to the opportunity of meeting you after. And with that, I will now turn over, we have a point of order, to Mr. Christofferson.
Thanks, Chair. I will be very brief, and I make this intervention as the longest-serving continuous member on this committee, and I'm referencing the presence again of the Parliamentary Secretary to the Treasurer. I accept that it is her right as a Member of Parliament and as a associate member of the committee to sit here, but I also think that, and I recognize this seems like a small matter, but it has big implications. The government ran on a platform of removing the influence of parliamentary secretaries from committees. And for the most part, that has happened, and it's been a good thing. And I have complimented that when we finally got around on PROC, where that was the case, where we got rid of the parliamentary secretary, and I gave the government credit for that. It was a good move. But I want to say that we are called upon here to get above our partisanship because we're the premier oversight committee in Parliament. And it harkens back to the old days that the government said they were going to be different with regard to when it comes to the parliamentary secretary being here. It cannot do anything but leave the impression that the government is riding shotgun on public accounts. And if ever there should be a committee where all of us are not being directed or influenced by the parliamentary secretary, it's here. And just 2 more points, Chair.
Well, very quickly.
Thank you. Number 1, I'm not alone, and this is not new. A colleague, Carlton Trail, Eagle Creek, was quoted in the paper recently as saying the Liberals promised to remove the influence of ministers and parliamentary secretaries on the committee, and this appears to be a broken promise. That's in that committee, and I would make the same argument here, that the government is not honouring the pledge that they made to remove the influence of parliamentary secretaries, particularly at the Oversight Committee, particularly given our major oversight is Treasury Board. So I'm going to leave it at there for now. I won't even mention the picture that the parliamentary secretary refused to get out of, that we were trying to take a picture of the committee, and we still couldn't have it because you and I wouldn't be in it unless the parliamentary secretary got out of it, and she wouldn't.
Okay.
So I'm asking the government, I've done it nicely, I've done it now my first time publicly, please honor your promise. We'll ask the parliamentary secretary to please not come to these meetings. It serves us all the best.
Thank you,
so
Mr.
much, Chair.
Thank you very much, Mr. Christopherson. And I would also say that any member of Parliament, if they are an associate member, can attend these committees. It is the parliamentary secretary is welcome to attend, but her input will be limited in that capacity as far as when they have a full contingent of people here. So it is a point of order. I don't want to dwell on it. We have guests here today, and so we'll just carry on. But we do welcome all members here for this. So we'll begin with the Auditor General of Canada's opening statement. Please welcome here.
Thank you. And Mr. Chair, thank you for this opportunity to discuss our 2016 spring report on the Venture Capital Action Plan. Joining me at the table is Richard Domingue, the principal responsible for the audit. Venture capital is a major source of financing for innovative, high-growth firms and their entrepreneurial owner-managers. Venture capital investment in early-stage firms has helped to create and grow many of today's leading global technology companies. Many countries are interested in promoting such an ecosystem since venture capital is widely recognized to be a key driver of innovation and economic development in advanced economies. In Budget 2012, the Government of Canada announced $400 million to help increase private sector investments in early-stage venture capital and to support the creation of large-scale venture capital funds led by the private sector. In this audit, we looked at how the Department of Finance Canada, the Business Development Bank of Canada, and Innovation Science and Economic Development Canada, formerly Industry Canada, assessed the policy need for the action plan, how they implemented the action plan in order to meet the stated objectives, and how they measured the performance of the action plan. Nous avons constaté comment
We found that at the time of the Budget 2012 announcement, the Government of Canada had already identified a number of issues faced by the national venture capital ecosystem, and that it had performed preliminary analysis of the market gap. However, the government had not yet decided how to allocate the money. The government then held consultations with stakeholders, a process that led to the selection of the Fund of Funds model as the preferred approach to address the challenges of the Canadian venture capital market. We found that the government initially faced difficulty in convincing private sector investors to participate in the action plan, which contributed to delays in implementation. Among the factors behind the reluctance were low returns, as well as strict international regulatory requirements for certain private sector investors. Further, management fees could amount to approximately $250 million of the total amount of $1.35 billion committed by the federal government and other investors to fund funds of funds over the lifetime of the action plan. We found some significant shortcomings in the process to select fund managers. In our opinion, the call for expressions of interest, the review of applications, and the selection of fund managers did not entirely adhere to sound practices and had a negative impact on fairness, openness, and transparency.
Looked at how the three entities plan to monitor activities in the short term and measure the success of the action plan against the stated objectives and outcomes in the long term. We found that the action plan activities were properly monitored. However, better performance indicators would help to measure the policy outcomes of the action plan initiative and inform future policy decisions. Also, better public disclosure of the action plan's performance could benefit the Canadian venture capital market. Mr. Chair, the Department of Finance Canada and Innovation Science and Economic Development Canada have agreed to our 3 recommendations and have prepared a detailed action plan. Monsieur le Président, je termine ainsi ma déclaration d'ouverture.
Mr. Chairman, that concludes my opening remarks. We'd be pleased to answer any questions you may have. Thank you.
Sir, and we'll now move to Mr. Botham, please. And again, welcome.
Thank you, Mr. Chair. And since you've already introduced my colleagues, I won't do that. But we certainly represent a team that worked on both the analytical aspects as well as the development, the implementation, and the ongoing management of the initiative, the Venture Capital Action Plan Initiative, or as I'll refer to it as VCAP. But I would like to take a few moments just to provide you with a bit of the context for the initiative, some of the process elements that led to the development of the initiative, and some of the preliminary results. So in 2010 and 2011, McKinsey & Associates, on behalf of the BDC and the expert panel reviewing federal support to research and development that was chaired by Mr. Tom Jenkins, examined the venture capital industry in Canada and found that there was a significant financing gap. It was largely attributable to key structural challenges facing the venture capital market, including a shortage of experienced managers, subscale fund sizes, and a lack of institutional investment in the asset class. These factors led to persistent low returns, decreased the attractiveness of this asset class, and subsequently limited firms' access to venture capital financing. The BDC also assessed the forecasted demand from Canadian fund managers looking to raise funds, as well as the forecasted supply of venture capital, and confirmed that there was a significant gap. While the BDC had been supporting the venture capital industry for some time, it was recognized that new approaches would be needed to address the structural challenges in the market. These analyses led to the announcement in Budget 2012 of a commitment of $400 million for venture capital activities, for which the government would conduct further analysis before defining its approach. The government rolled out an extensive consultations process, receiving 75 submissions through an online portal and hosting meetings with more than 250 industry stakeholders in Toronto, Montreal, Vancouver, Calgary, and Halifax, which included a number of members from Réseau Capital and the Canadian Venture Capital and Private Equity Association. In addition to these domestic perspectives, meetings were also held in Boston and Silicon Valley with a number of top-tier venture capitalists and other participants in the market. The government also conducted analysis on international best practices in Israel, Australia, Europe, and the United States. As with any consultation, while there were differing opinions, consensus formed around some of the following overarching themes, which informed the design features of the Venture Capital Action Plan. The new approach should be private sector-led and market-based, focused on demonstrating superior returns to investors. Although welcome, the funding announced in Budget 2012 would be insufficient on its own to create a sustainable industry and would need to lever significant resources from the private sector. Institutional investors left the venture capital asset class due to poor returns and the absence of large funds that fit their investment mandates, and they would likely only return if incented to do so in a different kind of structure. Venture capital in Canada was shifting away from early-stage investments towards later-stage companies, where it was perceived that risk was lower. The funding in Budget 2012 should be deployed to increase the number of private sector-led funding sources for venture capital funding managers. Investments should focus where Canada has existing strengths, such as information technology, life sciences, and clean technology. And finally, that some funding should be deployed quickly into the market given the immediate capital needs of innovative companies. Le plan d'action sur le capital de risque a été...
The action plan was launched in early 2013. It included a commitment by the government of up to $350 million to create 4 new private sector-led funds of funds with private sector investors, as well as interested provinces. It also included $50 million for investments in 4 existing high-performing venture capital funds as a means to quickly flow capital to the market. This was their purpose.
To allow the government to leverage the knowledge, expertise, and capital of private sector partners. A private sector expert panel was named to lead a competitive selection process for the general partners to manage the fund of funds and for the general partners of the high-performing funds. The panel established the information requirements for applicants, defined the selection criteria and evaluation methodology using industry benchmarks, and they shortlisted candidates for in-person interviews prior to making final recommendations to the Minister of Finance. In the case of the selection process for the funds of funds, recommended candidates made presentations to and were vetted by initial lead investors. Fund managers were selected by all lead investors, including governments. While the funds of funds have sectoral priorities, information and communication technologies, life sciences, and clean technology, these importantly reflected investor interests, fund managers' experience, and dominant market opportunities. During the design of the VCAP, the government considered various venture capital models from international jurisdictions, including those that had incentives to lever private sector investment. While a variety of incentive models have been used across the world in different jurisdictions, including those that allow the private sector partners to purchase the public sector position, the government chose a different incentive structure. In addition to the incentive structure, a number of other elements were negotiated by all lead investors, private and public. Negotiated elements enshrined in partnership agreements included the selection of the fund managers, the compensation arrangements for fund managers, and that included management fees. The VCAP has already been successful in achieving many of the intended outcomes. It has secured the expertise of 4 talented fund-of-fund managers, including HarbourVest, a U.S.-based leading global manager, which has opened an office in Toronto, Kensington Capital Partners, which has established a new office in Western Canada. These new office locations are important because venture capital tends to be heavily involved in its local market. Although fundraising started early, investors only wanted to commit once fund managers were identified and they had been vetted. The VCAP attracted a spectrum of diverse private sector investors, many of whom were new or returning to the asset class after a long absence. Fund managers were successful in attracting sufficient interest from investors based in Canada. A critical mass of domestic investors is an important signal of confidence in the domestic market to foreign investors, and it helps VC fund managers tap a broader pool of investment. The government's investments in the fund of funds model leverage significant private sector investment both at the funds level and at the underlying funds level. The 4 funds of funds have surpassed their target sizes and have raised a total of more than $1.35 billion in new venture capital financing, including more than $900 million from the private sector. Each fund met its fundraising target in less than 18 months, and that compares very favorably with industry standards. The Minister of Innovation, Science and Economic Development released VCAP data yesterday, demonstrating that as of March 31, 2016, the VCAP funds of funds had committed a total of $693 million of their total capital to funds and companies. This includes $555 million to 17 Canadian funds focused on different stages of company development and industry sectors. These 17 funds have gone on to raise a total of almost $2.5 billion for investments in entrepreneurs at the underlying funds level. In fact, 126 innovative, high-potential Canadian companies across various sectors all over the country have already received more than $420 million in financing. You will have seen the Auditor General's report and the government's responses, so I won't reiterate those findings. Together, Innovation, Science and Economic Development, BDC and Finance Canada have developed an action plan, which you have also seen, to respond to the recommendations of the Auditor General and follow through on those commitments. Should the government develop a new initiative similar to the Venture Capital Action Plan, we would certainly consider the Auditor General's findings and recommendations as part of our analysis and development. Je suis heureux de noter que le
I am pleased to note that the performance measurement framework has been updated and that VCAP data is available online on ISED's website. These address the Auditor General's recommendation on increased metrics and reporting.
understanding of the VCAP, we thank the Auditor General and his team for the report, and we will act on these recommendations according to our commitments in the action plan. We would be happy to respond to any questions from the committee. Thank you.
Thank you very much to our guests. We will now move into the first round of questioning, and we have from the government side, Ms. Mendez, please.
Thank you, Mr. Chair. Thank you all for your presentations and your presence here today. Ma question s'adresserait d'abord.
My question is for Mr. Ferguson to begin with, please. With regard to point number 5 in your presentation, you say that the government had difficulty convincing private sector investors to participate in the plan. You talk about the payback, management issues, etc. Low returns. Is there not also a problem with the very concept of the plan to have a government initiating this type of venture capital fund? Was that not part of the difficulties that you noted? No, it was just the policy of the government to put in place this type of system. It was a decision of the government to decide on the right way to prepare the way for this system. So for us, it wasn't an issue of questioning the policy itself. Simply, we identified a few challenges that existed in the initial stages, the first stages of the program. So it wasn't a situation in which we had concerns with the idea of the government's participation in this program. But I'm not talking about your concerns. I'm talking about potential issues. Would the government have issues? Or I understand full well that you weren't there to judge or decide if it was a good policy or not. But potential investors, did they have concerns, government-wise, with the idea that it was a government initiative? Mr. Chairman, microphone, please. What we noted when this initiative was launched is that they had a hard job convincing private investors to come on board. As we mentioned in the report, some of these concerns were essentially with regard to the structure of the fees requested, also the difficulty with regard to accountability. It was difficult for entrepreneurs to follow. So when we look at the time when the funds were closed, when they'd reached their full limit, we see that there are some funds that closed in March of this year only. So it was difficult to convince businesses, and there's also a regulatory framework under the Basel regulations. This type of regulations were not admitted, were not recognized. So the banking sector had a lot of hesitation coming on board in this initiative. Thank you. I'm still somewhat confused with regard to the whys. But I believe
Your presentation, Mr. Ferguson, that you also recommend that a better public discussion, the disclosure of the action plan performance could benefit the Canadian venture capital market. How would that disclosure be done? What would be your recommendation for a better disclosure?
Well, again, you know, this is a program that's dealing with $400 million worth of federal investment into the program. and there needs to be ways of being able to determine whether the program is being successful. I think we heard some indicators that were mentioned just now in the opening statement about some of the things that are coming out of the Venture Capital Fund. But the problem with something like an investment in venture capital is, from a profitability point of view, you don't know whether it's going to be profitable until maybe 15 years from now. So what indicators can be used to identify whether the companies that are actually being invested in? And I think that's one thing that keeps interesting me in this whole conversation, is we talk about how much money the government has committed, how much money the provinces have committed, how much money private sector has committed, how much money has gotten into the hands of funds of funds managers, and how much has gotten into funds managers. And there was I think again a number about the amount of money that has been committed to companies. But I think sort of what's interesting is understanding how much money has actually gotten to the companies. And what are they doing with it? What are the indicators that they have their ideas, and their ideas seem to be leading to commercialization and leading to something that is going to therefore be profitable? And I think it's trying to get down a little bit more into that level of detail, which is the information that people really need to be able to understand that, okay, yes, this program seems to be on the road not just to creating that ecosystem of venture capitalists, but also creating successful companies.
And 1 minute. Yeah, that brings me to the question of all the layers that are in the layers of management in this, if I may, because it was confusing to see that you have the managers, you have the managers of managers, and it's the layers of intermediaries in all of it, and how do you distill that into the ISET website and showing where the money is going and how it's becoming a reality in terms of eventual profitability. Because as far as I understand, there's at least 5 levels of disbursement of funds somewhere in here. From what I
finance or
could be BDC actually too, and there's from what I understand, there's capital funds to companies, but there's a Canadian funds focusing on different stages of company development. Then there's 17 funds that go on to raise a total of X billion dollars for investments in entrepreneurs at the underlying funds level, and then 126 innovative high potential Canadian companies finally getting some funding. So
our time is out. Our time is up, so we'll maybe
really
in another question.
I'm making a
back.
statement. Yes.
That's right. Thank you, Ms. Mendez. We'll now move to the opposition and to Mr. Poilievre. Mr. Poilievre, you have 7 minutes.
Thank you. Help me to understand the management fees. The Auditor General's report indicates that they roughly $250 million out of a total of $1.35 billion committed to the fund of funds over the lifetime of the action plan. What does that work out to in percentage terms on an annual basis?
I think that would best either to be to finance or BDC. Yeah. Go ahead, sir.
Sure. Thanks for the question. Neil Hill with BDC. We're the managers of the program for the government, and venture capital is not an easy
so the question is, what does it work out to in percentage terms on an annual basis?
Yep. There are 2 levels of fees. So the fund of funds managers collect approximately, on average, across the life of the program, 0.56% of the committed capital that flows through their hands per year. So that's the average across the life of the program for each of the fund of funds managers. Similarly, there's a second layer of fees, and this is where the bulk of the fees actually go. The underlying Canadian venture capital funds, who are receiving the bulk of the financing, they charge anywhere between 2 and 2.5% per year.
I'm not actually looking for a breakdown. I'm looking for a total, which is the opposite of a breakdown. What is the total annual percentage management fee for this initiative?
Over the life of the program, it is 19.6%. That's our calculation of the total capital. And the capital, then the life of the program is 12 to 13 years, depending how things turn out.
So it's 19.6 divided by 12.
Exactly, sir. Yes.
Okay. I want to ask about opportunity cost, and my questions here are based on two primary assumptions. One is that money is real, and that money invested is not merely digits on a screen, but that it represents real value. And two, that a dollar can only be in one place at one time. The Auditor General has said that the initiative needs better performance indicators and analysis. But I have found with all manner of government programs geared towards economic development, they miss half of the balance sheet. They only focus on the purported benefits and not the unseen costs. So $400 million invested through the 2012 budget is $400 million subtracted somewhere else. That money had to have been taken out of the Canadian economy. Perhaps it was borrowed at the time because there was a deficit in that year, but ultimately it has to be paid back. What methodology will Finance Canada employ to ascertain the damage done to the Canadian economy by the removal of $400 million from the hands that earned it, so that in order to fund this initiative?
Well,
Mr.
maybe I'll start and turn it over, since you focused the question on Finance Canada. We have not done any analysis specific to this $400 million. So we haven't done that analysis. But there is one clarification, I think, that's required to understand your question better, and that is actually whether this is an expenditure or an investment. And it does differ in that respect from some other categories of expenditure that governments have undertaken. And I think it's worth passing that to my colleague to explain to you how it is treated as an investment.
So the money that BDC uses is put to work in funds. The funds invest in companies. We at BDC been involved in the asset class for over 20 years, and we monitor performance of investment at the company level and at the fund level, and we aggregate that to BDC. So an investment that is made in the company at day one, $1 invested is worth $1 of investment of value.
Presuming you get it back.
At day one, the presumption is that it's worth $1.
On day one.
As that investment in the company is invested against promises of hitting milestone at the company level. So will your sale increase by 10%? Will your revenue increase by X? Will your profitability? And we monitor performance of the company, and we monitor it as well with other funds investors. So the dollar that we invest is worth something. A year later, if the company has not met their milestone, there is a reduction of the value of that investment by 25%. If, on the opposite, that company is hitting the milestone and is progressing and needs additional financing, if an external investor comes into the round and validates the value of the company, then there's an increase of fair value. So there's the cost aspect, and then there's the fair value. We monitor at BDC the cost, the dollar going into the company, and we monitor the fair value of that investment over time, validated by external investors and often U.S. investors. We carry and we report the value of that investment on fair value, and that fair value is a contribution to the net income of the bank.
If I may, BDC got its money through a public offering to the Government of Canada for this initiative. It basically sold more shares to the Government of Canada, right? Is that a summary? So the Government of Canada had to take $400 million from somewhere. Now, you might currently account for that as an accounts receivable, or that the government has an increased asset in its share of BDC, but bottom line is that $400 million is here, so it cannot be there. It came from somewhere. We know that. And what I'm asking is, in your doing this analysis, are you treating the $400 million as though it was created from scratch, or are you treating it as though it was displaced, it was moved, it was taken, either borrowed out of the economy or taxed out of the economy, but in one way or another, it was taken away from some other place and some other use, and therefore there is an opportunity cost? Are you considering that in your full analysis of the success or failure of this initiative?
Thank you, Mr. Poilievre.
It's treated as an investment
Thank you.
in balance sheet terms.
Time is up. We'll now move to Mr. Christopherson, please, for 7 minutes.
Thank you, Chair. Great. Appreciate that. Thank you all for coming today. We appreciate it. For the benefit of our international auditors, I just want to point out that I'm a member of the third party, and there aren't many benefits to never being the government. But one of them on this committee is that I'm never on the defensive because I'm never being audited. I never have to defend anything. And I always have the greatest respect for particularly the government members who are caught in a really tough spot. Number one, having to defend their government because they're part of a team. And that's expected of all of us, but also as a member of this committee where we try to be above partisanship, I make reference to my earlier comments, where we try to stay as much as we can above the partisan fray, which calls on government members, in this case it's the former government members who are sort of defending, if you will, or have that aspect, but for the government to legitimately the members be willing to legitimately criticize their own government when they've done something wrong or not as well as they should or wasted taxpayer money, that higher calling calls upon them while they know they got staff and others right behind them freaking out in some cases as they go forward and say this is wrong and it needs to be we need to ensure that it doesn't happen again. So but the reason I'm saying all of this to our guests is that is a lot to ask of a member, and I've been on this committee for a very long time, and I know how difficult it is. So the other part of the equation is that someone like me who never has to play that role, I think has an obligation when there's something close to good that the government has done to be willing to say so. And as much as colleagues will know, I just love ripping into these, and I see a colleague joining me who's been around for a long time. He knows how much I just love to rip into these things when we've got massive waste and get right into it. But I got to tell you, you're right. Except, hang on, John, hang on. Except, every now and then, there's an audit that comes along where somebody needs to say, with one exception, this is a pretty good audit. I mean, I had to get to page 13, before there was a recommendation. What I'd run into twice before then was that we made no recommendations in this area of examination. Well, when there's no recommendations, that tells me a lot as a member of this committee. And so I think it behooves me to say that on balance, if everybody's audit came in roughly where this one was, a lot of the work that we do would be in the past because we would have achieved what our ultimate goal is, which is to change behavior so that people follow the rules, are focused on following the right procedures and making sure that all those pesky little boxes are actually ticked, that there's a reason for them. I just want to, I'm going to go to an area that's a bit problematic, but it won't be my usual style because it's not deserved. I want to compliment all of you on what I would say is a relatively good audit. And I would hold you up as an example to the rest of the government on a lot of key areas in terms of the things that you got right. And so today's one of those days, Chair, where man bites dog, and I'm complimenting the former Conservative government, and I give the Conservatives their due that this was not a bad audit, given some of the nightmares that we've seen come across our table. So thank you very much for the job that you did, and these kind of compliments don't come very often from me, so if that's worth anything at all to you, hold it close, because it's sincere and heartfelt. You did, it's a good audit, not a bad audit, and I wish we could see more of these. Having said that, I don't have too much time. I deliberately used in fact, how much time I got left here?
Minutes left, but I was just going to say on behalf of the former government, now I'm starting to worry when we have you on side.
Yeah, well, don't extrapolate too much from it. But hey, credit, no, really, on this committee, you got to take the blame when you've done wrong, but you know, darn it, where credit where credit's due, and I want to make sure that we do that also, because otherwise we're talking hot air when we talk about our lofty goals of trying to be nonpartisan and hold whatever government to account regardless of their partisanship. The only reason I had to put a disclaimer in my comments was that in the one area, whenever I see the Auditor General use words like significant shortcomings, that's an alarm bell. You know, the Auditor General is very careful about the language that he uses, and when that office says significant shortcomings, that needs to be paid attention to. So that was the one thing that kind of stopped you from getting a even more glowing report. But on this, I have 3 minutes later, one more question. But on this one, the thing that troubles me is that you reserved the right on page 13 of the Auditor General report. It said it indicated, that it reserved the right to make changes to the selection process and to select any firm that it preferred. And then I hear that you had some trouble in the beginning getting people to sign in, and things like that would certainly jump out to me. Can I just ask you, what was the rationale for you determining that that was fair?
Mr. Boffin, please.
So just two things. First, in terms of the difficulty that was referenced to get participation, I believe, and I can be corrected by the Auditor General in his office, I think that is in reference to investors. And I think what you are referring to is the selection of fund managers. Okay. So that's just one
But the two aren't related? The investors weren't looking at the way you were selecting the fund managers and having a problem? Totally unrelated?
I think the criticism of the process is in relation to the selection of fund managers rather than the investors is a separate issue.
Okay, fair enough.
But in terms of the selection of the fund managers, I think the rationale for including that was simply, well, twofold. One, this was a process that we were really developing in part as we went. There were significant uncertainties in terms of the reaction of investors, and we were really trying to make this a process that would meet a perception test in the market, both in terms of the final outcome, who was selected, and that the fund managers would be seen to be credible. So we wanted to build in flexibility for lead investors to have a role in the selection of the fund managers. If government alone selected fund managers and then went out to private investors, pension funds, banks, corporations, and said, please commit $100 million to this fund manager that you have had no role in selecting or vetting, we would have had more difficulty in raising funds than even the challenges that were faced that have been highlighted. So we did try to adhere to the normal standards of disclosure, openness, transparency that a standard government procurement would follow, knowing that this was not a standard government procurement, because governments were committing, and in the end, a very small proportion of the capital under management. Government funds were $1, and private sector dollars were 3 times that. So that was the reason for that.
Thank you very much. We'll now move back to the government side, and we will go to Ms. Shanahan, please. Ms. Shanahan, you have 7 minutes.
Thank you very much, Chair, and thank you very much, gentlemen, for being with us here today. And thank you again to the Auditor General for explaining to us, reminding us of what our role here is, and that is not to question policy, much as we might want to question policy of a previous government. The fact is that we're here to review how the policy was undertaken, how the program was undertaken, and it really is a learning exercise for us to see, if there's any changes that we need to make to the existing program where it is now, and then what we would want to do in the future. And I get it that even though it's big numbers and it's kind of disconcerting and costs and so on, we're talking about venture capital, new businesses. There's a cost attached to searching out those new businesses. Not all of them are going to make it. There's going to be a bunch that fail, but we're hoping that we get that next Google, are we not? We're hoping that we're going to really encourage the ecosystem here in Canada. So I get that. That being said, what concerns me is the public sector participation, the government's participation, that there was no exit strategy that was chosen. And so my first question is to the Auditor General, because you mentioned that in the report that the absence of early exit options for the public sector partners could send a message that the public sector's participation is intended to be permanent. And, the intention, of course, is that we would get out eventually. So could you please explain that a little bit more for us?
Well, I think that's fundamentally sort of the issue that we were raising was, we were looking to see whether there was that type of an exit strategy. We had seen that perhaps in models used in other places. And we just raised the issue so people would be aware of it, that without sort of a structured exit strategy, there could be that some could see that as a signal that perhaps the government was planning on staying in on a more permanent basis. I don't know. I'll ask Mr. Domingue if he has anything else that he'd like to add to what we've already stated there.
Mr. Chair, I think one can see exit strategy as the ultimate performance indicator. When the government decides that the system is sustainable enough, the ecosystem is led by the private sector, it's time for us to de-invest the investment made by the public by the taxpayers. It's the ultimate performance indicator, and it's in that context that we suggested that next time, if there's ever a follow-up to this VC initiative, maybe you want to consider an exit strategy. The VCAP, the way it was designed, did not allow for that, but next time, if there is a follow-up to more public funding in the VC world, maybe you want to consider that ultimate performance indicator, which is the exit strategy.
Thank you very much. And so then I would continue then with the gentleman from the Department of Finance and the BDC. What are the performance metrics that you are looking at? So we have money invested right now, and I'm sure we're not the only ones that are concerned about how those 126 companies are doing and how they're performing. So what are the performance metrics that are being used now?
Sure. I'll turn that over to my colleague from Innovation Science Economic Development, because their ongoing role is to develop that kind of framework, to report on it and make that information public. If I may, just on the exit strategy, the investment made into the funds of funds is not an ongoing investment. So if there is a sense that that is an ongoing commitment, that further funds are being made available, that is not the case. It is a single investment, one time into funds, and by making that investment, there is a return. So the exit strategy, there isn't an option for the government capital to be withdrawn from the funds early. And so that is absolutely true. It was designed so that the investment would actually be deployed and that returns would be provided back to the government. And so it's not ongoing forever. It is within the life of those funds.
Then would you comment further then on what would bring about an exit strategy? Where would be the time? Is that a political decision or a...
I'm a little curious about the notion of an exit strategy because the Government of Canada is active in the venture capital space through its financial crown corporations. Each one of them, Export Development Canada, Business Development Canada, Farm Credit Canada, they all are active in the venture capital space. So the notion of, is there a time at which governments will get out of that space? Absolutely, if it is a self-performing industry,
Okay,
but that would
not
be...
the whole space, but for that $400 million.
But I'm curious as to why it's an objective for the $350 million investment in the funds of funds to be withdrawn before the investment is actually made and that there are returns received. I'm not certain why that would be an objective.
What is the expected life of the investment?
It will vary, but it's 12 years on average.
Okay, so
Yeah.
so there is some timing around that.
Oh, absolutely,
Okay.
because it gets deployed in companies, companies grow, they pay back their investors, and as an investor, the government gets a return. So just a bit of context, I guess, from my perspective.
Back to innovation or
Measurements.
to, is it Mr. Padfield?
Great. Just to be clear, we've got a performance management framework for the initiative, and we're happy to share it with the committee if they want to see it afterwards. And it's really built around sort of three key themes, right? Seeing how the VCAP is impacting the venture capital ecosystem, how it's supporting the underlying companies, and how it's building the next caliber of fund managers in Canada. And so we have a whole series of indicators, and it's been complemented by some of the recommendations that the Auditor General made in his report, really targeting down in terms of some of the performance of the actual underlying companies and those things. So it gives you a bit of a flavor of like how much follow-on investment we're seeing from firms or for funds after the VCAP, and some of the performance of the actual firms and within it. So happy to share that if that's a useful piece for you.
If you file that
Thank
with the committee.
you very much. Our time, unfortunately, is up. We'll now move to Monsieur Gaudin. Monsieur Gaudin, vous avez 5 minutes.
Mr. Gaudin, you have 5 minutes. Thank you, Mr. Chairman. It's my turn to thank you for participating in this exercise. Now, what I find interesting is that what you've put in place, what has been put in place, it was built in 2012 and previously because the exercise had been prepared for before and was put in place in 2012. And I thank my colleagues for having underscored the good work of the government in place, but there's always room for improvement, and that's why we're here today. With regard to the Office of the Auditor General, you recommended that Department of Finance and Innovation, Science and Economic Development, etc., should expand the Venture Capital Action Plan's performance measurement framework by considering the inclusion of performance metrics. What led you to draw up this new list of metrics? What did you build it upon? I'm continuing to read through the text. Export growth, the financial performance, new patents and patent citations, and the number of new key investment personnel and lead investors. I'm not going to repeat everything that's contained in the report, but what did you base yourselves on to draw up this new list of metrics? Mr. Chairman, we looked at what other jurisdictions do, and when you look at 1.4, we're referring to New Zealand, to Finland, to the United Kingdom, and we see that in their performance reports on their venture capital activities, they include these types of performance indicators. I would also underscore that in the department's response, once the data becomes available, they will include indicators such as R&D expenditures and the number of jobs created. One of the key indicators for innovation is the patent issue, as we mentioned in 1.4. So this idea of commercializing innovation and it is a very relevant indicator that tells us if the venture capital investments have led to technological innovations or not. What I understand is that this data isn't available, and when the data does become available, you'll use this information for determining what indicators might be used further. Is that the case? Who's the question for? I saw Mr. Niez react. Please respond. We follow our investments through companies. We're able to report on the number of jobs, the number of staff. These are companies that hire in IT. These are often people who have doctorates, etc. So we have data on jobs, we have numbers for the growth of the companies, we have data pertaining to the sales of these companies, and in the case of several of our companies, I'm talking about BDC, we follow the patent applications. So we have an awful lot of metrics at our disposal, and we like to follow the performance of these companies. And we will have information that will flow over time, indicating whether or not these companies are developing when we invest. Oftentimes, it's when the company is just sprouting, just beginning. There are 2 or 3 staff, and then we see what happens over time. The technologies have to be defined, validated, and then sales have to be generated. So that is part of the metrics that we follow at BDC, and this will apply to this program, to the VCAP program. What you're saying is that the Auditor General's office added some elements that you already use. So the recommendation of the Auditor General is simply to mention these things, but you're already applying this, yes, and we'll have data on the companies in the VCAP portfolio as they evolve over time. I'm a new company. I'm a startup. I have experience in another sector of activity, but there's a new technology, sustainable development technology that's available, and I need risk capital, venture capital. Could you outline for us the process for the small business person who is looking for money? And we see this in all of our ridings. We have people who are seeking out financial levers in order to launch a company, their company, or a section in their company with good technology but lacking funding. First of all, when you're a startup, the government supports several accelerators throughout Canada. BDC has 13 in some specific sectors. For green technology, foresight, and in Montreal we have another one, another accelerator. That's a good place to find assistance at the very beginning of a business. That company might spend 6 to 12 months in the incubation stage. They're entitled to services, professionals, and other venture capital companies. They're introduced to them. There's a dialogue that is launched in the interest of investors, taking into account interest on both sides. A first investment is done at the very beginning. So it could be a check of $500,000, $1 million, and this helps the company develop and accelerate its development and the sale of its technology. Afterwards, there are other investors that come on board. So there are funds, accelerators that are specialized in certain sectors, funds specialized in other sectors, and what we want is to marry the two, the abilities of the managers and the needs of the business person. And through our portfolio, we support more than 700 companies with our accelerators, our funds, and our direct investment.
Mr. Chen, please.
Merci. J'ai combien de temps?
Thank you. How much time do I have?
Highlighted the delicate balance that needs to be reached between commercial confidentiality and greater transparency. And I note that within the report, it points out that the Departments of Finance and Innovation Science and Economic Development did not release the information that was collected by the Business Development Bank of Canada, Crown Corporation, on the activities arising from VCAP, the Venture Capital Action Plan. So my question to the departments is, in terms of making that information available to the public or reporting it to Parliament, what are the concerns, what are the risks of making that information available?
And maybe I can start in on that. If I'm not mistaken, I think the report from the Auditor General was highlighting that as the initiative moved forward and as money was put out into the economy, there should be better reporting to Canadians on results, how the money was being deployed. So I think it was more on a going forward basis, and that is part of the reason why the Minister of Innovation, Science and Economic Development released information as part of an annual reporting cycle that was released yesterday, but I'll pass that to my colleague to give more information on.
Yeah, I think if you make reference to the action plan we put forward in response to the audit, we're being clear that we're going to start reporting on an annual basis in May. It really is the last fund of funds closed its fundraising not that long ago, so we're still very early days. So some of the metrics that I went through in terms of our performance framework aren't going to be that meaningful because there hasn't been companies are only just beginning and investments are going forward. So we were looking for the period for when those performance metrics would make the most sense and look the most real. But if you look at the release we made yesterday, we've highlighted where some of the investments have gone to date. So I'm not sure we're in any kind of concern with terms of confidentiality. We know what pieces are covered under confidentiality agreements with the fund managers, and otherwise we're making as much information available as possible because, again, we're happy to see and let everyone know what the performance of the funds and the activities underneath.
Thank you. So to take that further, I know that the report looks at what other countries like New Zealand, the United Kingdom, and Finland have done in terms of releasing performance metrics. And you have mentioned just now that information was recently released. Is that sufficient in terms of what has been made publicly available? What can we learn from what other countries are doing so that we can have greater transparency in the data that we provide to the general public?
Yeah, I think the Auditor General could speak to the views on what we put forward originally, and they'd given us some helpful suggestions in terms of some of the more company-level information. So, I mean, and we're always happy to evolve this as we go along, as we find more and interesting ways of making the information more accessible to folks. But I think the plan for us is we want to make the performance measurement framework public, and then we're going to report out against it. And we've identified some of the pieces in the action plan, and the goal is to take sort of the data for this fiscal year and have it reported out in May of next year so people can see the overall performance and some of the underlying indicators there too.
So I think there are a few things in terms of sort of all of the performance indicators. And I think that we've heard today, for example, that BDC has a lot of information about the companies that are being invested in and what they're doing and how they're tracking, and industry as well is tracking quite a bit of information. I think what our concern mostly is about, well, what information do you have as a parliamentarian? So this is, $400 million that the government has put into these funds of funds. As has been described, that $400 million is not an expense, right? So it did not affect the government's deficit 1 cent at the time that it was made because it's considered to be an asset. So, BDC has to track very carefully to make sure that that asset continues to be worth $400 million, and it tracks a lot of information. I get a little bit concerned, as I said earlier, that, a lot of what we keep hearing about is, $1.35 billion committed and all of that. But I don't think that there's, and this is for you as parliamentarians to decide, but I don't think there's really a lot of information about, okay, how much of this money has actually gotten into the hands of the companies, and I think that information was part of the report released yesterday, how much has actually gotten into the hands of the companies. But we still don't really know sort of, who those companies are. We don't really know what progress they're making. There's some categorization between, whether they're a seed company or various different levels. But I think it's more, what we were trying to point out is it's not an issue of the information doesn't exist. In fact, the information does exist. It's more an issue of, okay, it's $400 million that the federal government has put into this investment, and it's being monitored and it's being watched by BDC and the other departments. But, is there a certain amount of information at the public level that you as parliamentarians should be receiving so that, you understand exactly where this money is going and what it's being used for? And I think that's really what we were pointing out. And when we looked at things like what was going on in other countries and what academics were recommending and that type of thing, it was all those types of possible public indicators to help give you as the people that sort of oversee everything, some information about, okay, there is some progress being made, and it's not just, yes, there's the importance of building the ecosystem of fund managers, but fundamentally, to the extent that the companies are going to be successful, that's probably the number one key. This is $400 million, but, based on the report yesterday, that $400 million hasn't all yet gone into individual companies. And I think it's just important that you understand all of those parameters about what this program's about.
So our time is up, but before we go to the next, I guess the question is, what was the rationale for not reporting this information to Parliament and to the public? And was this information shared with the private sector partners that participated in the Venture Capital Action Plan? So, if one of you can answer that.
Well, maybe I'll take a run, but maybe my colleagues are going to chime in as well. So private sector investors would have the same interest as the Government of Canada in monitoring their investment. And so they would certainly be watching the progress of the investment and its performance. So that doesn't differ, certainly.
In terms of funds of funds, investment funds, investors participate at LPAC, which is annual meeting of all investors in the funds. So at those meetings, the fund goes through each one of their investee company and report progress against the original intention or the original strategy. So BDC and other investors go through all of the companies under the fund portfolio and all of the fund performance under the VCAP, and we get full report on progress of these companies.
Every private investor would have that information you're telling me? They'd have the aggregate rate of return that they would be expecting or that they'd see?
Exactly. And each investor in a fund of fund, that fund of fund would invest in funds. If that investor is, let's say, invested in Terralis invests in funds, that investor would have line of sight on all of the underlying portfolio.
And so back to what the Auditor General suggested, I'm not certain that, and I don't want to put words into his mouth, but I'm not certain from what I heard that he's satisfied that Parliament has yet received the information that we would need in order to understand those things. Very quickly, because I don't count, and we are on a timeshare here.
Just to be absolutely clear, what the Auditor General commented on was our performance measurement framework, which we had intended to release information publicly, and it added a few additional indicators to it. So there was never any intention of not reporting publicly. Every intention was there. What they commented on was an existing performance measurement framework that we had prepared and added a few other indicators to it. So it wasn't that we weren't reporting out, it was just they added a few other additional indicators to the performance framework.
Okay, we may come back to that. Mr. Poilievre, please.
Yes, I realize the Auditor General is correct in saying that this is not an expenditure. The 2012 budget didn't expend $400 million. What in fact happened is there's an asset, which is the investment, and but in order for that money to be provided for the investment, it had to be secured from the consolidated revenue account. Is that accurate?
Yes.
And in a deficit year, which it was, we can, even though money is fungible, we can assume that the money would have been borrowed. Is that correct?
That's correct.
So we would be paying the going rate on that money, whatever. I'm not sure what the government marketable bonds were going for in 2012, but
Nor I.
But over the 12 years, there is an accumulated cost, even just to money.
Yeah.
I guess what I'm trying to inculcate here is the notion that our analysis of these kinds of initiatives should not only take into account the purported benefits, but the actual costs. Otherwise, we leave ourselves with the false notion that there just are no costs, that this was just created out of nothing. Do you have any intention of including any such analysis into your into what you publish, your performance indicators?
So, as I understand you correctly, the government cost of capital should be taken into account when the government thinks about what the return is on that capital, and there should be some kind of adjustment made for that to get a real rate of return, given that the money was borrowed and there is a cost to government capital for all expenditures, investments as well, but investments are performing investments until proven otherwise. So
I do believe that, yes. And any net costs, I would suggest to you, should also consider the harm. We should also consider the harm that those net costs have, if there are any, on the economy that paid for it, right? I mean, I know that some of your indicators are the number of people who will be employed, you mentioned earlier on, but companies that pay taxes employ fewer people. The more tax they pay, the fewer people they employ. Now, I realize these things are hard to measure, but I know that Finance Canada does have some methodology to measure these things. I know that when a proposed reduction in a corporate tax rate is made, that Finance does analysis on how many net jobs it will create, or an increase will reduce. So, we get these reports as this process unfolds. Would you consider matching the purported benefits with the actual economic costs of deploying the public money in the first place?
So, as I indicated, I not having given it a lot of thought since you've just raised it, but it seems to me the relevant adjustment is the government cost of capital in this case. So
okay, we'll have to agree to disagree on that. I'd like to move on to predetermined returns. In the Auditor General's report, it says Class B investors provide money earlier but receive distributions after Class A investors receive a predetermined level of returns. So the Class A investor is the private sector, the Class B investor is the public sector. What is the predetermined level of return that the private sector investor is promised?
If I could speak to that. That's actually a rate of return. It's an interest rate that is covered by a confidentiality clause in the limited partners agreement between the investors and the managers.
I'm not asking for the actual rate, but just tell us how it works.
Yep. Shall I just describe the flow of the funds on the way out?
Yeah.
So we refer to it as a waterfall. So the private investors, when there are returns to be had, the capital comes out and the private investors get it first, and the private investors get all of the returns until they have been kept whole, brought whole on the capital that they previously put in. Then they get a return, the stated return, the preferred return. Then they get their management fees that they've paid into the fund of funds rebated to them. Then the government goes through the same cycle.
Can I ask just a quick clarification?
I can't take any more questions. We'll let them finish because your time is up.
Thank you. So then the government goes through the same cycle. Our capital that's been contributed comes back, the preferred return, the fees, And then and only then, after those 2 cycles are complete, does the fund manager have a right to start sharing in the profits of the fund.
Okay, thank you. Mr. Area, please, for 5 minutes.
Thank you, Mr. Chair. Mr. Patfield, the question is for you. Mr. Botham gave big numbers. 126 Canadian companies got invested with $420 million. But when we look at it, our original investment of $350 million or $400 million, it was the funds of funds raised $1.35 billion, right? And out of $1.35 billion, $555 million was invested in 17 Canadian funds, which in turn raised $2.4 billion. And out of the $2.4 billion, $420 million has been invested. So when you do the math, probably less than 10% of the government funds have been invested, correct?
That went by very quickly,
yes.
But,
okay,
but I would say...
Let me repeat.
But I think the math,
is a little
different.
Sometimes when I talk fastly, people have
that's fine.
difficulty
The
in
math is a little different than that, I think. So if you, $350 million of Government of Canada money across 4 funds which total $1.35 billion.
Correct.
So I think the calculation is really government accounts for 25% of total capital.
Correct. Out of 1.35 billion, 555 million was invested in 17 funds.
So far.
Approximately 40% of that.
But yeah, there are 2 things, I guess. One is that is a milestone along the way because not all capital has been committed and not all capital has been deployed.
I'm talking of the percentage here. So 40% of that was committed. But basically, you said you're adding additional metrics for reporting. Does your report state how much of government's $400 million has actually been invested in these 126 companies?
We don't know exactly where every government dollar's gone. I mean, we look at the overall pie.
Listening to this $420 million investment to
because it's a
126 companies.
Sorry, I guess.
The Auditor General has made it clear that one of the key indicators is how much money is going into companies and what is company performance at the end.
I understand that.
And so it's for that reason that's part of the reporting.
But if we can't link the investment made that has been published to the amount of government's investments.
Go ahead, Mr. Padfield.
Sorry, to be clear, it's our percentage of the overall investment, just on everything. So it's our percentage on the overall investment, right? So we put in a $350 million, and we've raised, another $900 million.
We put in $350 million. We invested $420 million.
No. It's so maybe.
Yeah.
Maybe I'll walk through it. So, 350.
Quickly, I got only 2 minutes more. I got another question.
Complicated question.
Maybe,
I'll walk through it quickly. I'll talk even quicker.
I got one question for the BDC. This $400 million, you issued shares to the government for this $400 million. Did you have a separate category or classes of shares for this?
We track that investment as a VCAP program, issue shared in lieu of injection of capital, and we report separately. It gets rolled up in BDC Capital, which gets rolled up in BDC, and we report it as separate segment of the BDC
So when
operation.
you get the distributions from the investments you have made, how do you transfer it back to the government?
Because we'll be tracking the investment and the return of capital, and the objective is to return more capital that we've received.
Understand, when you get the returns from the investments you have made, how are you going to transfer that to the government?
Typically, the Business Development Bank of Canada provides dividends.
I know, but if it is merged, this $400 million is merged into the equity capital of the BDC.
No, Jérôme said it's tracked separately. Share purchases are separate as well.
So now, with the remaining of the $400 million that you have not yet invested in the funds of funds, obviously it must be earning some returns. Even
no, the Government of Canada provides capital as we request. We only requested some capital to initiate the program, and we'll be doing a capital call sometime in next year or so.
So how much it has released to you till now? How much you have requested till now?
250. Yeah. 250 out of the 400.
Okay, out of 250 million that has been released to them, how much of that money is invested in the 420 million of 126 companies?
25%.
Hard to say off the top of my head. We'd have to go back.
Okay, that's okay. And secondly, we know that
has to do with the timing of capital calls.
Okay, and okay, last question.
I think
guess,
this point of
with
clarity.
the BDC, excuse me, BDC been after them regarding their investment in the manufacturing startup, which is close to nil. They invest hundreds of millions of dollars in all the loans, unsecured loans they make. But when I asked, they invested only $24 million in the manufacturing startups in the entire last year. So out of these 126 companies, how many are in manufacturing sector?
Thank you, Mr. Area. Okay, on questions like that, I would just, I'll tell you at the end of the meeting, but also now, if you can get back to us on that, is it 25%? I mean, what is the number? And maybe even just a review of you know, of the money in, the kind of what you've walked us through here in the last few moments. Mr. Poilievre, you have 5 minutes.
Goes into the company, that's through equity and not debt, right?
No, I'm sorry. Hang on.
Mr. Godin.
I'm sorry, it's Mr. Christopherson.
Twice today.
We'll come back to you.
Once at Proc and once here. Really? Do I have to make more noise? You really don't want
Way
that.
you go.
You don't want that.
Time clock's running.
Thanks, Chair. I just have one question, unless I don't like the answer. But the question is relating to page 13, 1.64, and it actually goes back to that previous discussion. There's still parts of that are troublesome for me. I'm just going to read this and ask for your comments, and I'll jump to the end. It takes us to that difference between an investment and a procurement, and I got that message earlier, but it's in this context. I'm just going to read 1.64. Quote, during the consultations prior to the establishment of the action plan, there were many calls for a formal request for proposals or a competitive process. Among the stakeholders referring to this need were representatives of one of Canada's associations of venture capital firms. Initially, the Department of Finance Canada considered that the action plan would require a competitive process. In the end, the department approached this as an investment and not a procurement. And I understand that puts it in a different category and would have different rules apply. But still, I'm finding it hard to believe that you didn't take more seriously the request for proposals, a competitive process, particularly when one of the stakeholder groups. It wasn't an individual firm. I could understand they might have a vested interest in seeing a certain outcome or nuance on a particular aspect. But here you have the umbrella group that represents them. I'm assuming that they've got tons of credibility and they're sort of the go-to umbrella group under venture capital firms. So why did what looks like you so cavalierly set that aside and go off in your own direction?
So it was a competitive process. It was launched publicly. It was launched through Réseau Capital and the Canadian Venture Capital Association. We worked closely with both associations all through the process.
Okay, well then, fair enough.
So all I can say is I am not aware of any
man.
concern that the Venture Capital Association has in that respect.
Fair enough. Then I turn to the Auditor General. Obviously, I've misinterpreted your paragraph, or I'm not getting to the essence of what you were saying based on the answer I just heard, which would suggest, no, everything's okay, Dave, and here's why. So Auditor General, help me understand what was the issue that you're raising in 1.64 that I'm just not getting right.
Well, I think the fundamental issue that we were raising was, yes, they went through a process, and that process was about, trying to attract the interest in the market in this role. But I think as we lay out in the next number of paragraphs, because it was treated as an investment, it didn't follow the rigor that you would find in a normal procurement process. In the end, it looks like it perhaps has not caused a big problem, but it could have caused a problem. Whenever there's this type of an arrangement, and you have in the expression of interest that you reserve the right to pick anybody, I think we identified that the scoring mechanism was changed. I think it wasn't even developed until after the bids were in, and then it was changed during the process. You know, and one of the companies that was picked wasn't even a company that had put in a bid in the first place, right? So just a number of things that could have made somebody question whether the process was or was not fair. And I think the warning here is less that there was necessarily a problem at the end of this one. I mean, they've got companies in place. I think the warning is more, you know, whenever departments decide that something is not a procurement process and therefore they can do some things that are outside a regular procurement process, that should be, you know, that really raises the risk that at the end you could have people say, well, wait a minute, this process wasn't fair.
Very good. Thank you. Thank you, Chair.
Thank you. We'll now move to Mr. Poilievre.
Back to Mr. Hill. Thank you for your very good explanation earlier on. I want to build upon it. As I understand it, the money invested in the companies is equity, it's not debt.
That's correct, yes.
And so when the private or Class A investor is repaid, is it a share buyback by the company?
Rarely. The proceeds are generated typically when either the company goes public, and therefore their stock is liquid, and the investors are able to sell their shares for cash, or they're acquired, and then those shares are then traded for cash or stock in the acquiring company, which then can become cash. So that's typically what happens when the company down below reaches an exit event, as it's called. Then those dollars flow back up to the fund that's invested into them, and then that fund in turn pays their investors, one of which might be one of the VCAP funds of funds.
Right. So the Class A's get paid out, they get a prescribed return, then the government gets paid out, and then the manager gets a bonus if he's done all that. Okay. Then with respect to the question of early stage, as I understand it, the Auditor General defined venture capital as investments in early stage enterprises. The Globe and Mail, though, had a report today on the VCAP and said, and I quote, the money also made its way down to late stage growth investments, accounting for 35% of capital VCAP and committed. Can you explain how a third of the money went to late stage investments if it was supposed to be for early stage investments?
It was the agreements with the fund-to-fund managers specify the types of venture capital firms that they can invest in based on those firms' strategies, and those strategies extend from early stage through growth stage, and that was part of the program from its legal inception.
And I would suggest that there's very little late-stage money available in Canada. 50% of the money going into late stage are coming from American funds. So even, you know, the size of funds in Canada are pretty small. So even the stages are much smaller in Canada. The size of check going into later stage are half of the money that an American company would typically have. So at each stage, it's half of the money.
I don't mean to interrupt, it's just that the parameters of this program are very important because we have extremely advanced capital markets in this country. I don't think there's any argument to be made that there is a generalized shortage of available investment for companies that are seeking it across the economy. The market failure purportedly addressed by this program is for venture capitalists and defined by the Auditor General in this report as early stage. Is there mission creep here into areas that go beyond the purported market failure that we were supposed to be addressing?
In 2012, was it easy capital? Was there easy credit? Was there availability, or was that part of the reason that we came with it?
Can I just start off? Sometimes there's a lot of variability in the way that people use terms. So growth capital has a different meaning for different actors. Is there mission creep? No, because there are legal contracts which define the scope of the investments that fund-to-fund managers can make. And I'll turn to Neil, who would know more, but generally we're talking about Series A rounds. We're talking about kind of $2 million to $10 million investments in companies. Growth stage in the context that we're talking about are still relatively early and relatively small tickets. Others would be talking about a growth stage that is like far beyond what these funds are operating in. But Neil can...
Yeah. So growth stage venture capital is what we're talking about, this being a venture capital program. And out of approximately 60 venture capital funds that are active in Canada now, there are only about 3 that have as their primary focus growth stage. One major one of those happens to have been in the market when this program got underway, when the initiative got underway. And so there's a bit of an accident of timing in terms of the concentration in that stage so far. We actually expect that the concentration in that stage to decline as we go forward, and additional commitments are made to earlier stage funds, and we return to a heavier earlier stage focus.
Thank you. We'll move to Mr. Harvey, please.
Thank you, Mr. Chair. Just one quick question, really. My only question is just following up on Mr. Poilievre's earlier question. Seeing as how this money was generated initially from the consolidated revenue account, is it not felt that it's necessary? I follow Mr. Poilievre on this, that I believe that we as government should be monitoring what the total cost of borrowing is, or total cost of investing. So, the initial investment that went there came from consolidated revenue, and we should be monitoring that year over year, at least, say, at different increments throughout the life of the investment, to determine what the total cost of that investment was. So not only what the total cost of the initial investment, but also the net cost associated with that investment. So, Mr. Botham, I just want to ask you, do you believe that that is important or not important to Canadian taxpayers to know that they're getting tangible value for that asset? Recognizing that venture market capital is a very risky business, and I totally agree that the federal government has a responsibility to be in that marketplace, but I also think that the Canadian taxpayers have a right to know how that investment is performing versus where that other money could have been.
So I think there's kind of a narrow specific answer to that and a more general one. So the narrow specific one is the Government of Canada does not track a dollar of debt that is raised against specific dollars of expenditure. So it is not possible to say X dollar in X program is related to X dollar of debt raised. So that's kind of a difficult and impediment to get over. But that being said, very clearly Canadians have an interest in the debt level of their governments, and that is transparent, and there are costs to carrying that debt. There is no doubt about that.
But the cost incurred with borrowing the debt in 2012, because that's essentially what we did is we borrowed the money that we invested.
Well, actually, I'm sorry, and it isn't quite that way as the explanations have happened, because
what I'm saying is there's still a tangible cost. There's still a tangible cost to that money that was invested.
There was money committed.
There's a tangible cost to the money committed.
No, but I'm making a distinction that's real. There is money committed. The money flows, as we've explained, over time through share purchases, some of which have happened, some of which will happen this year, some of which will happen next year.
I understand
and as that money flows in, it is, or prior to it flowing in, government goes and raises money in the markets. So it's not a question of tracking down the when the government went to the market in 2012 and the cost of that capital.
No, but what I'm saying is that each point along the way, I understand that all the money is not flows through all at once, but at each time that money is committed from the federal government to this fund of funds as their portion, there's still a cost associated with each time that happens over the life of the fund of funds. So there's still a tangible cost there, along with the cost of administrating that fund, right?
Which is built into the capital cost, but I take your point.
Right.
Yeah.
So there is a tangible, real, calculatable cost.
I guess my assertion is it's not calculable. It is in the abstract, but are we going to look at the 90-day bond that's released, the 10-year bond that's released, the 30-year bond, or the 50-year bond? Which one will be used to, because governments don't tag when they go to the market to raise money, they do not tag that debt to a specific expenditure. It's to cover government expenditures over time. So in principle, I completely understand what you're saying. There is a real cost to servicing debt, but it's not a calculation that can be made in respect of an individual dollar which is spent or invested.
Okay, thank you. Thank you, Mr. Harvey. I will now move to Mr. Gaudin.
Mr. Chairman, I think you put a good question, Mr. Harvey. There is a cost. How to calculate it and on what basis do you calculate it? I can understand that we haven't identified on which calculation basis this can be established, but clearly there is a cost. 400 million in 2012 were taken out. It's going to be reimbursed, and perhaps there won't be a return of 12% if we say we're going to head to 12% because we've been paying interest since 2012. So I do understand your question. I have another question. We're talking about venture capital here. It's an investment in a company to provide financial levers for startups. I think it's important as a society that we encourage innovation, and I believe that this is one of the missions of the Innovation Department. Might you be able to tell me I'll say this in English, the scoring system, the point system, you don't have a 100% average success rate. What is the success rate? Or let's look at the reverse. What is the failure rate in the companies you wanted to assist, but who unfortunately didn't succeed and you lost money as well as all of the private partners involved? Because there are companies, there are Googles in this world that were prosperous, that succeeded, but there are clearly other companies that unfortunately fell by the wayside. Might there be an indicator? I know that this goes back to 2012, so there isn't much history, but have any predictions been made? Thank you for the question. We're able to see the performance of companies and the performance or non-performance of companies. To date, there have been positive outcomes. Shopify, for example, was in the portfolio of one of the funds, and they were able to have liquidities. And 4 companies to date did not succeed, so they were a write-off for the funds. And as the program moves forward, we will see attrition for some investments, but there will be value added for many investments, because we see companies that are performing well in the portfolios, and there will be an increase in the value of these investments. Is there going to be compensation? I think the selection of the funds was well done, and the funds that receive funding now, I'm confident that they're good investment teams, and the return on the investment this year is about plus 5% when we launched the program, and even when we did our strategic review at BDC, it was minus 5%. So we see an improvement in the return for this category of investments. It's very positive because that's how we'll be able to seek out other investors who will see a potential return in that area. So there are very encouraging signs. It's encouraging. Thank you indeed.
Merci beaucoup, Monsieur le Président.
Thank you very much, Mr. Chairman. In fact, to come back to the Globe and Mail article, I would like to conclude on a positive note. I believe that we all would like to see positive news. You provided several answers. I asked several questions, but it's not really my field of expertise. But I do really appreciate the Globe and Mail article that gives a good explanation of the report that came out yesterday.
That talks about the choices that you're, as a fund or a fund of funds or however you want to call it, that it's going to be made for the next stages, where they do mention that there's been too much, 79% of the money has been committed to ITC, so the information and communication technology, that there's a certain preoccupation, not enough has been put in the clean energy sector or the life sciences. Have you been looking at this? Is this something where you would like to make some changes? So
yeah, thank you for the question. I think the 70% of investment in venture capital is in the ICT sector. That's the industry norm. The fund of fund have some specificity in terms of areas of focus. HarbourVest is an ICT fund. Kensington is an ICT and a clean tech objective. Terralis has an allocation for life science fund. And we're seeing a normal distribution being established in terms of fund investment. So these funds of funds are making investment in different sector. Genesis is one life science fund that got some fundraising from the VCAP program, and you're going to see an increased diversification. There was a great pent-up demand in 2012 because the fundraising was very difficult, and some of the funds were IT funds. They got funded quickly, and then now you're seeing other funds approaching and establishing relationships. So we're confident we'll have diversification, and we're seeing it right now.
And do I still have some time? Yeah. And apparently there's perhaps a possibility of a VCAP 2, or anyway, I'm basing myself on what the article says. So I presume that it's based on a somewhat measured evaluation of success, wouldn't you say? And I said that the department has judged that this has been working well. If there's this possible enthusiasm for a VCAP 2.
I can't really speak to ministerial decisions on whether or not they'll, move forward with a second round. I mean, that's really up for ministers to consider. There's been.
But can you speak to your general satisfaction with the way the fund has been managed?
Well, I think the early indicators are in terms of attracting investment for bringing fund managers. We've checked off a lot of the initial intent of the objectives of the program, which was to bring in greater investment, to bring in, some greater new fund managers. And I think Jerome walked through a number of the activities that have come in terms of new offices being put in place and for some of the fund-to-fund managers. So yeah, we've checked off a lot of the initial intent of the program. But in the long run, we're still looking to see positive returns. And some of those longer-term indicators in terms of the performance measures around firm stuff, we're still waiting to see where those are going to be. And overall returns, too, for the investments, right? We're still very early days, so we're not seeing any of the return data that's substantial.
Well, thank you very much. That's it.
Mr. Poilievre has a question, and we do have one quick question from the analyst just in the preparation of our report as well. So I'll ask that.
Just a brief comment. I do agree with Mr. Harvey that the cost of capital is calculable, if only by a weighted average in the year in which it was borrowed. I mean, this year we're borrowing $130 billion as a government, and it's in 2, 5, 10, and I think there's even going to be some 30-year bonds. I'm sure that there's a way to weight the average of interest on those and calculate what we're actually paying to displace this money over the course of the 12-year life cycle. But I think we've had enough discussion on that, and I thank you for all of your answers. Now on to the opportunity cost for the money leverage from the private sector. Do you have any modeling over at Finance to determine if the money contributed to these funds by private sector investors is actually incremental business investment for Canada, or simply money that would otherwise have been invested in the Canadian marketplace but was directed here because of this incentive, this government incentive that is available for venture capital investments but is not available for other forms of investments?
Boy, that's a complicated question because it speaks to the intent of the investors. I guess one way I would look at it is the incentive structure that was put in place was the subject of very intense negotiations between Government of Canada, other governments who are participating in this, and private sector investors. From the Government of Canada's perspective, we tried to minimize the level of incentive while at the same time attracting capital. Private sector investors have invested because they feel that the amount they've put into this framework will return to them something that they could not get otherwise. So absolutely the incentive skewed the investment decisions. It was meant to do that. And, you know, these, a number of these are large, sophisticated investors that invest all around the world. So an example, CPPIB. So did the money that CPPIB put into these 4 funds of funds come out of money that they otherwise would have invested internationally in ports or airports or roads? I guess it is because they have a fixed amount. But these are international investors, so the proportion that they might have otherwise put in Canada, I don't know how I could come to any calculation of that. And the same for the, you know, it involves all the major banks, National Bank, some corporate investors. So tough for me to make that calculation, but I understand the question.
Could I just tag on one specific
Mr. Hill, yes.
Thank you. You used the word incremental to the space, and that is one of the discussions around the program because its intent was to generate incremental capital for venture capital investing in Canada. From speaking to the 4 fund of funds managers who bore the brunt of the fundraising, the $904 million in private sector capital that's come in, their feeling is that at least 2/3 of the private dollars that came into their funds is net new money to the Canadian venture capital ecosystem, that had it not been for this program, it would have not gone to Canadian venture capital. Beyond that, I can't speak.
Okay. All right. Thank you. I don't want to make it sound like this is my question. This is coming from our analysts, but it's just so that we can get a little clearer input, I think, into the report that we may be looking at reading. And I'm not certain where this even should go, if it would go to perhaps Mr. Hill or Mr. Botham. But the question, the government and the private sector industries are getting information about the rate of return and the list of companies, but not Parliament. So why is that the case?
Well, I'm going to have to defer to my colleagues on the list of companies. I'm not sure. But the rate of return, well, there is no calculation right now of the rate of return. And it is a dynamic concept. I'm not sure what to do with that, actually. Is there some point at which, I mean, there certainly is some point at which there would be a reporting on rate of return, but go ahead.
Mr. Hill?
Sure, thanks. Yeah, we're using industry standard measurements of fund performance. So they're called TVPI, total value to paid in capital, and distributed to paid in capital. So I don't mean to get into jargon, but we are reporting on the financial performance of the fund. And that will certainly be part of the annual report to the performance management framework that Industry, Science and Economic Development is responsible for compiling and providing. So I'm assuming that will get to Parliament as it gets to everyone else. We also, within that though, the list of companies actually is a bit of a touchy matter. Because if any of you have dealt with early stage entrepreneurs, they are often very, very jealous of the quality and sensitivity of their idea. So often, the funds that invest in these companies often have a confidentiality agreement with those companies that they cannot even disclose that they have invested in those companies.
But other private sector companies would perhaps get the information, as would the government. Is that correct?
There are some exceptions even for the private sector investors. Right. So anything that the private investors get, we can get access to through the program, and we will provide that. I'm just saying that there are instances where the list of companies might not be complete because of a confidentiality situation. So.
All right. Thank you. In the course of this today, some of these questions, like the last one that has taken, a fair bit of thought, you may want to respond in writing to an answer to better express, or so that we might help us understand a little clearer. And we would encourage you to do that if there is something that triggers on the way home. The other thing, Mr. Padfield, you also talked a little bit about the performance management framework. If it would be possible for our committee to get a copy of that sent to our clerks or our analysts, we would certainly appreciate that. So I want to thank you for coming. This is for the layman, this is very difficult. I'm not certain about the viewership out there and across the country, how many would be watching the technical aspect of venture capital investment. I mean, for the people involved in the industry, they may find it very interesting. For startup programs and for new entrepreneurs, they may find this very interesting. But I certainly recognize that we have a panel of experts here today, and we thank you all for your input, and to our Auditor General, thank you for doing a good job on this report, and we look forward to seeing you again. So thank you very much, and we will take a 2-minute recess. You can say goodbye to our guests, and then we would invite our friends from around the world, other auditors and Auditor Generals from other countries, to come up here, and we'd like to meet you and perhaps get a picture with you. We'll recess for 2 minutes.
Thank you for your help.